Imagine you have $10,000 ready to invest today. The question is, do you put it all in at once or drip it in gradually every month to feel safer? Most people instinctively pick the second option, but it turns out decades of data show something pretty surprising. And it might change the way you think about the right time to start investing. If you found this helpful, hit the like button and consider subscribing. In this video, we're going to talk about what dollar cost averaging actually is, what lump sum investing is, the studies that compare the two head-to-head, and most importantly, how to figure out which one actually fits your profile. But first of all, this is not financial advice. Welcome back to the channel, where we explain investing concepts in a simple way. Okay, so picture yourself at a fruit market, and you know the price of mangoes goes up and down every day depending on weather and harvest. There are two types of buyers. The first buyer shows up once, buys a whole basket of mangoes that same day, whatever the price is. The second buyer is more patient. They come back every week, buy a little bit at a time, sometimes at a high price, sometimes at a low price, but on average, their price ends up more balanced over time. That first buyer is basically lump sum investing, putting your entire amount of money into the market all at once, at a single point in time. The second buyer is dollar cost averaging, or DCA, splitting your money into portions and investing it at regular intervals, usually monthly. Let's break this down further. Say you have $12,000. With the lump sum approach, you put all $12,000 into the market on day one, done. Your money starts working at full force from that day forward. With the DCA approach, you might split it into $1,000 a month for 12 months. Every month you're buying at a different price. Sometimes the market's up, sometimes it's down. Because of that, the average price you end up paying is usually more neutral than trying to guess one perfect entry point. Sounds good, right? DCA sounds like the psychologically safer choice. You don't have to stress over is now the right time to get in, because you're getting in a little bit every month. But here's where it gets interesting. Vanguard once ran a study comparing the performance of lump sum investing versus DCA across 3 different markets, the United States, the UK and Australia, using decades of historical data. The result? Lump sum investing beat DCA about 2/3 of the time tested. Why does that happen? The reason is actually pretty simple once you think it through. Stock markets historically tend to go up more often than they go down over the long run. So if your money gets into the market faster and more fully, statistically, that money has more time to grow compared to money that's still waiting its turn to be invested through monthly installments. This is where we run into that classic principle. Time in the market beats timing the market. The longer your money is actually working in the market, the bigger the potential compounding you get. Let's look at this through a story about 2 people, Dana and Ray. Dana gets a $12,000 annual bonus in January. She puts all of it into an index fund that same day, the lump sum approach. Ray gets the same $12,000 bonus same month, but he feels more comfortable easing in, so he invests $1,000 every month for the whole year, the DCA approach. If we assume the market generally trends upward that year, which historically happens more often than not, then by year's end, Dana's portfolio tends to come out ahead. Not because Dana was smarter or braver, but because from January onward, all of her money was already riding the wave with the market. Meanwhile, Ray's money that only went in, say, November, only got to enjoy the last 2 months of gains. Now, here's an important misconception we need to clear up. A lot of people think DCA is the smarter strategy because it reduces risk. That's not entirely wrong, but it's not entirely right either. DCA does tend to produce slightly lower returns than lump sum over the long run, statistically speaking, because part of your money sits idle waiting for its turn to be invested. But on the other hand, DCA has an advantage that can't be measured in returns alone. It reduces psychological risk. Imagine if Dana had put all $12,000 in the day before the market dropped 20%. Mentally, that's a heavy thing to sit with, even if the market will eventually recover long term. A lot of people, seeing their portfolio drop sharply right at the start, panic and sell at a low point, when really they should have held on. This is where DCA earns its value. It helps you stay consistent and less prone to panic, because you're not putting all your eggs in one basket at one moment that could tear. This is where DCA earns its value. It helps you stay consistent and less prone to panic, because you're not putting all your eggs in one basket at one moment that could turn out to be bad timing. So the question isn't just which one is mathematically more profitable, but also which one can you actually stick with without it stressing you out so much that you end up not investing at all. So, what can you actually do with this information? If you have a large sum of idle cash, a fairly high risk tolerance, and a long-term investment horizon, the historical data tends to favor lump sum investing, because statistically, your money has more time to compound. But if you're someone who gets anxious watching market swings, or you're worried you'd panic sell if the market drops right after you go all in, DCA might be the more realistic choice for you to actually follow through on. Because the best strategy on paper is useless if you can't handle it mentally. There's also a hybrid approach a lot of people use. Invest part of the money as a lump sum and drip the rest in over a few months. It's kind of a middle ground that helps cushion the regret if the market happens to drop right after you go all in. So, which one is better? DCA or lump sum? As always, the answer is, it depends on your goals, your timeline, and your risk tolerance. Historically and statistically, lump sum wins more often, but consistency beats perfection. And if DCA is the only way you can actually stay consistent without panicking, that's not a wrong choice either. What matters isn't finding the perfect strategy on paper, but finding the strategy you can actually stick to for the long haul. Also worth remembering, this is historical data, and past performance doesn't guarantee future results. Studies like this Vanguard one are mostly based on the US, UK, and Australian markets. Conditions can be different in other markets. If you found this helpful, hit the like button and consider subscribing. What about you? Are you more the type to go all in at once or ease in gradually? Let me know in the comments. If you like this video, you'll probably like the one on how index funds work too. Again, this is not financial advice, just education so you can make decisions with more context. Thanks for watching and see you very soon.